relief measures, which meant that people who had borrowed 7 trillion were given some more time to start paying some of these loans, which is more than 1 year. And I think that helped on some of the sector. We see that up to now, actually the demand for credit restructuring has really come down. We are talking about, as of March, we are seeing only 61 billion months value of applications for restructuring compared to 2.6 trillion when we started. So that means that actually the people have already benefited from our own restructuring, which has really helped. There are some sectors, obviously, like schools, like restaurants, hotels, that are, it is really still very difficult. Overall, I think that's one arm. Now, on the CBR reduction also helped because I think in 2020, January, there about December, what we call weighted average interest rates, meaning that looking at people, each loan people have borrowed, and you put on the interest they have borrowed it at. It came from 20 to around 18 as of April, which is okay, slight reduction, but also helped in the sense that, for example, we are talking about government facility under UDB, that where borrowers pay 12%, but some commercial banks lend money as low as that to particular sectors, manufacturing, etc., under the easing of monetary policy, which is also helpful. But I think the question of Uganda is that most of the borrowers are small borrowers. So someone is borrowing 10 million at 30%. Those are the majority of the borrowers. But the guys who have establishment, they are big enough, like some of the manufacturing sector firms, they can borrow as low as 15–12% in the commercial banks, compared with UDB that gets money from taxpayer and then lends at 12. Those are really comparable. So overall, I think monetary policy has really helped in terms of providing liquidity. Leave alone, by the way, even the private sector. Think about the government. A government paper now 91 days is at 7%. So it automatically means that even for the government to borrow money from the financial system, it is borrowing at a low cost with the CBR at 7 than before. So if the government can borrow at 7 for 91 days, or even for 1 year now is around 10%, and it gives the money to, including Ministry of Health or even the money that is going to UDB, it automatically means that actually the monetary policy has really helped the economy. So you have to look at it in a form of, say, the Uganda economy as a whole. It could be that private sector, the private individuals, firms, may not necessarily have got loans as low as 10% or 12% as in aggregate. But overall, I think helping the economy really has helped. The next question then comes to, then what about the next financial year? Now, the next financial year is, we still have question marks, or what is famously known as known unknowns. Now, for example, we don't know the evolution of COVID. Is COVID going to be much rampant as compared to this financial year that we are ending? If so, it requires obviously even things that we are talking about, credit facilities, probably to be extended until further notice. So all those things are still unknown. They are still evolving. So it is still really very hard to start judging what monetary policy is likely to be in the course of the next financial year, given the unknowns. Now, on the positive side, the economy is already recovering. You saw the numbers from the Bureau of Statistics. Economy is grew at 3.3%, expected for this financial year. Next year, financial year is 4.3%, so which is a positive outlook. So if the economy is recovering, then it automatically means that there are some measures that were taken that really help the economy to boom out. And I think that's what we are, some of the indicators, we are waiting for to firm up the aspect of the recovery.
You touched on an issue around the MSMEs and looking at the numbers, even looking at URA's data. There's a lot of people in the MSMEs under the informal sector, and they're not captured in the system. But also when you look at your bank data, it speaks to those borrowing 10 to 50 million as quite a sizable number of people that actually are physically driving or actually drivers of this economy. And we're wondering where you as a bank are capturing them, if the monetary policy interventions may not necessarily capture them based on the rate of the CBR.
Well, you know, that is a fundamental question we have been grappling with, because you are talking about small-scale enterprises. You know, some of them are informal, not registered. You know very well the probability of any one of them surviving beyond 5 years is as small as you know. So the question under that arrangement, that's why actually their borrowing costs are very high, because as a lender, you are saying, okay, this firm is likely to go under within the next, the next 1 year or so. To what extent do you want to expose yourself to the risks? So sieving out those that are, are likely to survive. Survival means, a question of management issues, question of very many issues that go under those particular sectors. So those are the issues. Now the question comes, what is the role of the central bank under that? Apart from saying, okay, we deal with the banking system to encourage them as much as possible, even for the small-scale enterprises. If you have a loan that is you are fighting to repay, can you be encouraged to go and negotiate for the structuring? Okay, so that's really, as a central bank, that's what we encourage. On the other hand, you have a situation also where government is coming in strongly to support SMEs. So if Bank of Uganda was create, for example, a fund for SMEs, and also government is creating a fund for SMEs, now you have, you are likely to start fighting for the same sectors, okay? And remember that if we give money, create a fund for SMEs, it is under what is called it is still under government liability. In the case of default, you push over the bill to your shareholder, who is the government. So it becomes part of the contingent liability. So you leave that space therefore to government. To government, borrow the money, borrow even from the central bank as a government, create that fund, and therefore help them, help this particular SMEs. That's why we're talking about, why I emphasize that once you reduce the policy rate, even the bit of the government to borrow cheaply to fund the particular enterprises like SMEs become cheaper. So that's really what the role of the central bank would be, rather than having direct, intervention in some of the sectors, and where if we made losses, obviously, then it becomes a contingent liability on the part of government.
Let's talk about the affordability of the capital in the market. Even when you brought the CBR down to 7%, there were specific tough statements you shared with the banks to bring down their lending rates, and we saw the market come to as low as about 16–15%. As you spoke to the numbers, analysts are saying, and critics, that maybe there's the lack of appetite to go back into the banking sector to pick money out and re-energize or re-engine the economy is because the rates are just not attractive. And given the fact that you mentioned we are in that unknown space with COVID, then your local investors, domestic investors, are saying we'll wait out this and maybe stay where we are at the moment. So there is a lack of reinvestment in their business because of the cost of capital, even with UDB say at 12%.
No, I think it is not a question of saying that the cost is still high. It is a question of uncertainty. Even if you are small, really a credible enterprise, whether household enterprise, whether it's a corporate, would start looking at uncertainties in the economy. Because, I mean, you don't know to what extent COVID is going to be disruptive again. How then do you go and borrow benefits at 5% and you put, say, in a building construction, and you don't know whether you'll get a client because of COVID, because of another lockdown? So those uncertainties are really what drains, demand. And you will see that, like in 2020, demand was really quite subdued. Even if you pushed money, the extent that people were, enterprises and households were not willing to borrow. The demand for loans declined sharply during that time. It is only of recent that we have started seeing a pickup. Instead, you will see that households and particular enterprises were accumulating savings, which shows that actually the future was so uncertain. Rather than spend or do anything, you'd rather hold the savings. You see that time and savings deposits in a commercial bank were growing in the range of 20% in particular months in 2020, which shows that actually whatever a person got, emphasized the saving because of uncertainties rather than spending. Now, that was really what was driving the domestic demand down. Now, when the economy was reopened and things started normalizing, we started seeing a reversal. As of, I think, of April, we started seeing now people were starting to save, meaning that the extent of the growth rate in time and saving deposits in the commercial banking system had again declined, because people now were confident that the economy is recovering, so they are starting to normalize their activities to consume. Those who like importing, etc., have started, also those who are doing investment. So that is the story. So the question therefore is, to what extent can you credibly bring back confidence within the economy, so that a private person, whether a consumer, whether an investor, can credibly say, I can go walk to a commercial bank and borrow and then invest and get a return. Note that in the case of Uganda, actually, in the cases when the economy was booming, people were not fearing to borrow at 30% because they knew that their returns were coming very fast enough, and therefore they would go for 30%. But because of those uncertainties, that's where people started pulling back, waiting and see. Now, that's where I think establishing, rather confirming that with the numbers, that the economy is on recovery. That triggers the aspect of people, households, and businesses really taking up the opportunities. And therefore, we have started seeing demand for credit again rising. And the supply also has picked up. We saw when credit on annual growth was down to around 6% on annual basis. Now, by I think March, it had gone to 9%, 10%, which automatically means that the credit growth has started picking up because the demand is there and the supply was also there. But in 2020, both demand and supply were really subdued. So basically, that's the story. So the story is not necessarily about the price. Price, yes, is an attribute, but also people, if you put it at 5, as you already said, 12% at UDB, and people are not still as interested simply because there's a question marks. And I think that's the area where, that's the environment we are in, bringing back confidence within the system. I think that's, it will take communication, and also takes about the controlling of the virus.
You collect a lot of data on this, and we've seen in the last 2 years government push the conversation on economic social transformation, but specifically speaking to creating jobs and creating work for our people. And we've also seen quite a lot of money as the drivers creating these jobs. Does the data you collect speak to this as a way of transforming and quickly bringing up the numbers in terms of the economy?
Well, I mean, social economic transformation is not it is a long-term project. I think we have to know it from that angle. And it involves many aspects. Well, industry is really picking up. Manufacturing has really picked up. It still has challenges, yes. for example, if you go to Namam Industrial Park, you see that they have real challenges. The roads are move from Namambe to town where they are putting the goods in the stores. You will take more than 3 hours, and that's a short distance. So those are the challenges, and I think working on those challenges will really is part of the part and parcel of the transformation we're talking about. But overall, I think industrial parks manufacturing is picking up strongly. We see it in the data. Employment is a question of, because also the population is rising very fast. Every year you are adding 3%. So the few jobs you are creating, and given that people now are entering the labor market at a faster pace, that's where you have a challenge. But still, overall unemployment, you're talking about 15% or so, is, obviously, underemployment is where there's a problem. Because you can be 2 million border riders, you are all employed, but basically you are underemployed. Probably the industry will do with half of those if they are fully utilized. So that's what we are seeing in the data. So employment is still far off. Creating decent employment in the case of Uganda is still far off. And it requires well thought through integrated approach. Linking agriculture, for example, if you start a fruit factory, say in Soroti or in the whatever, how are the farmers producing for the factory in a good quantity, in a good quality? So it involves a lot of households, it involves the ministries of agriculture, it involves the extension workers. So you have to create that environment, the ecosystem where actually enterprises are speaking to one another. And I think that's really where you see there are some of the challenges. You hear that a factory was opened for fruit and then there was no supply. And this is not new. Many years ago, I remember when we started talking about sunflower, and there was no sunflower for Mukwano to process into oil. So those until Mukwano himself started going to produce sunflower himself. So there are those challenges. I think, so having a well-articulated plan in terms of production, in terms of processing, value addition, having a full value chain will become very instrumental, for economic transformation. And it is not a one-year project. We're talking about a well-articulated plan for more than 5 years for it to have meaning.
Doctor, let's talk about the economic drivers for this financial year that UBOS is speaking to, about 3% growth, and you're also speaking to a 4% growth in the next financial year. What were the economic drivers, given the fact that before COVID we had agriculture and coffee as fundamental contributors to economic growth in the country? What were your drivers for this financial year?
Now, let me start from the easier part, the demand side. Because whatever you produce must be consumed, okay? 70% of our GDP is the household consumption. So if you want to stimulate demand, and therefore which is spill over into production, it is expenditure side, household expenditure. So you see that, like the year that ended the financial year 19/20, household consumer expenditure was around 3% gross. In normal days, it is above 6%. So for the year that is ending this June, we're talking about now recovery to around 5%, which is slight recovery. So which means that household expenditure, consumer expenditure, contributes substantially to aggregate demand, which aggregate demand feeds into the supply side. So that's one angle of it. However, from the expenditure side also, you see that what we call investment, which sharply declined in the last financial year, around minus 1.8. So also picked up a bit in the financial year that is ending in June, which automatically means that yes, on the investment side, people are still have started reconstructing their businesses, buying in machinery. Although the purchase of machinery is still real, you will see it from the data that people are not importing machines yet because of uncertainty. So that's one side. Now on the production side, agriculture has remained the focal point from the data. It was not affected by COVID. It was affected by COVID indirectly through demand, like when we had lockdown. But basically, in terms of production, was not really substantial. The sector that we have seen booming coming up is manufacturing or industry actually, which industry has construction, mining, and electricity, water, and also, I also said manufacturing. We have seen it recover from a contraction in the last financial year to a positive growth. Now, remember, service sector takes almost 43% of output, value addition in terms of output. That's where we see some challenges. Service sector like hotels, restaurants, schools are really still contracting, which even this financial year that is ending. So we have a 2-year period, two financial years where growth rates in particular service sector, including restaurants, etc., are declining and education. That's really substantial. So overall, the service sector, which contributes 43% of GDP, is where growth is really wobbling. But the industry and agriculture are really, growing positively. So even therefore, in the next financial year, we are still projecting that even with this partial lockdown again, will not affect the industry, will not affect agriculture. Some of the service sector, including like education now, will slightly be affected, including restaurants and bars, recreation services, etc., will still contract. But I think the growth in agriculture and probably manufacturing will somehow contribute to the growth of the 4%. Now, if we had another serious lockdown, obviously that's a different story, because also agriculture would be affected indirectly, and also the rest of the industry group. Yeah.
Thank you, Doctor.
Yeah.
Thank you very much.
Thank you.
It's always a pleasure.
Thank you.
Talking to you. I've been talking to Dr. Adam Mugume, the Director, Research and Policy at the Bank of Uganda, on our budget conversations.